Markets are near record highs, but our next guest ain't buying it. He expects a 20% correction in Q1 and says a Fed hike is more likely than a Fed cut to start the year. Greg Branch is the CNBC contributor and founder and managing partner at Veritas Financial. Greg, listen, I gave you you're sticking with it. You're not throwing in the towel. Why not? What gives you such conviction as the stocks just continue to rip higher?
Well, Kelly, I have to see the underlying data change. And so while certainly the Fed's posture changed, which was a surprise not only to me, but I think the vast majority of bulls would say that that posture change was a surprise as well, the underlying data really hasn't. And so, yes, back in October or back in late September, what kicked off this rally is that we saw core growth of CPI go down to 20 basis points. And we saw the jobs number go down to 150,000. And what some of us warned at the time was that you couldn't extrapolate a new paradigm for that. And that's exactly what happened. We saw core bounce back to the bandwidth that it's been in for the last 16 months of 30 basis points. We saw jobs number bounce back to 199,000. We saw unemployment retrench to 3.7%. And so when you look at these key numbers, we've been in a holding pattern for the vast majority of 14 months. And so while the year over year number continues to decline, the month over month number hasn't seen much disinflation at all. And as we get to those,
look, we just got some negative PPI readings.
Right. And remember, it's not goods that we're worried about, right? It's the services that we're worried about. And so that gets us to the other number, which is the unemployment number. And we're still at historically low claims. And so I don't see anything that is moving us from 3.7 to what the Fed indicated what they need for a 2% baseline inflation, which is about 4.4%, particularly if they're going to ease in posture, if not policy. And while those numbers remain the same and the base effect becomes less favorable, what we're going to start to see is that year over year number is going to start to appear as though inflation is retrenching, and it very well may be. And so until some of that underlying data changes, I just can't change the outlook that it's more likely that they raise minimally, but that they raise before they cut.
Greg, that also doesn't mean that people should just not invest or not be in the market because they're scared of what could be or what could happen or anything else. Is there any way that investors put a shopping list together for what to buy or what to sell based upon this kind of an outlook? It has to stand to reason that people still have to be invested in this kind of market.
Yeah, Dom, I have my own shopping list, in fact. And so you're exactly right. And what I've failed to mention is I don't see a specific catalyst necessarily in the first month or two of the year. So I do believe that this rally will continue to run, even if ever so slowly, until the items that I've mentioned become more apparent. And while we are running, I think the key thing to do is look at three areas. The first is those with very strong secular tailwinds, even though they may seem a bit expensive. We see generational tailwinds in AI. We see generational tailwinds in cloud, and the names there are clear, the Amazons, Microsofts, Googles of the world. The second category are things that participate in those same strong tailwinds, but haven't participated to the degree that first category is. And cybersecurity is a great name there. Palo Alto, Zscaler, CrowdStrike. They are essential to whatever is going to be the future of AI and cloud, essential to both of those ecosystems. You see a lot of these companies up 100%, but that's probably not the magnitude that we'll see them at a year from now or 2 years from now. And then the last is those categories of things that have to catch up, that have not participated, even though we saw a lot of that catch up happen in December. So financials, for example, is a sector trading at a forward multiple of 14.5 times, less than the S&P, had a so-so year, barely up to double digits. But if you believe, as I do, that yields will return to levels that we saw a month or two ago, the net interest margin environment becomes more favorable. We see the M&A environment becoming more favorable. If you don't believe, like I do, that the yields will return and then we'll get cuts, check out the income generators, something like utilities, which also hasn't participated.